This video provides an overview of the major concepts covered in Chapter 14, Options Markets. Speculators can use stock options to benefit from their expectations. Financial institutions can use stock options to reduce their risk. Options markets facilitate the trading of stock options. Chapter 14 includes 8 key learning objectives. First, to provide a background on options. Second, to explain why stock option premiums vary. Third, to explain how stock options are used to speculate. Fourth, to explain how stock options are used to hedge. The fifth learning objective is to explain the use of stock index options. Sixth, to explain the use of options on futures. The seventh learning objective is to discuss the use of options as executive compensation. And finally, to discuss the globalization of options markets. Let's start with some background on options. Options are classified as calls or puts. A call option grants the owner the right to purchase a specified financial instrument such as a stock for a specified price, called the exercise price or strike price, within a specified period of time. A put option grants the owner the right to sell a specified financial instrument for a specified price within a specified period of time. An option is said to be in the money when the market price of the underlying security exceeds the strike price for a call option or is below the exercise price for a put option. Options are at the money when the market price is equal to the exercise price, and options are out of the money when the stock price of the underlying security is below the exercise price for a call option or above the exercise price for a put option. There are some key differences between purchasing an option and purchasing a futures contract. To obtain an option, the purchaser must pay a premium. The owner of an option can choose to let the option expire on the expiration date without exercising it. Thus, the option to buy or sell a specified financial instrument is not an obligation, unlike a futures contract. Options are traded on organized exchanges, such as the Chicago Board Options Exchange, the International Securities Exchange, or the New York Stock Exchange. Options can also be traded over the counter. Each exchange has its own requirements concerning the stocks for which it creates options. The Options Clearing Corporation, or OCC, serves as a guarantor on options contracts traded in the U.S., which means that the buyer of an option contract does not have to be concerned that the seller will back out of the obligation. Options trading is regulated by the Securities and Exchange Commission and by the various options exchanges to ensure fair and orderly trading. As with stocks, an investor can place either a market order or a limit order for an option transaction, and option contracts can also be purchased or sold online. Quotations for stock options can be found at financial websites. This exhibit provides an example of stock options for Walmart stock. Examining the 4 options illustrates how specific factors affect option premiums. First, comparing options 1 and 3, which have the same expiration date, reveals that an option with a higher exercise price has a lower call option premium and a higher put option premium. Second, comparing options 1 and 2, which have the same exercise price, reveals that an option with a longer term to maturity has a higher call option premium and a higher put option premium. Although financial institutions sometimes take options positions for speculative purposes, they more commonly use options for hedging. This exhibit summarizes the use of options by various types of financial institutions. Now let's discuss the determinants of stock option premiums. Stock option premiums are determined by market forces. Call option premiums are affected by 3 key factors, starting with the influence of the market price. The higher the existing market price of the underlying financial instrument is relative to the exercise price, the higher the call option premium will be. Call option premiums are also affected by a stock's volatility. The greater the volatility of the underlying stock, the higher the call option premium will be. Finally, call premiums are influenced by the call option's time to maturity. The longer the call option's time to maturity is, the higher the call option premium will be. The premium paid on a put option depends on the same factors that affect the premium paid on a call option, but the direction of the influence varies. The higher the existing market price of the underlying stock is relative to the exercise price, the lower the put option premium will be. The greater the volatility of the underlying stock is, the higher the put option premium will be. And finally, as with call options, the longer the time to maturity, the higher the put option premium will be. Because the anticipated volatility of a stock is not observable, investors can input their own estimate of it when calculating the premium that should be paid for a particular option. Some investors, when assessing a specific stock's risk, adapt the option pricing formula to derive an estimate of that stock's anticipated volatility. Economic conditions and market conditions can cause abrupt changes in the stock price or in the anticipated volatility of the stock price over the remaining time until option expiration. This exhibit identifies the underlying forces that cause option prices to change over time, thereby impacting the stock's option premium. Now let's look at speculating with stock options. Investors can use call options to speculate based on their expectation that the price of the underlying stock will increase. Consider an investor who expects Steel Co. stock to increase from its current price of $113 per share, but doesn't want to invest in the stock itself. The investor purchases a call option on Steel Co. with an exercise price of $115 and pays a premium of $4 per share. Before the option's expiration date, Steel Co.'s price rises to $121. At that time, the investor exercises the option, purchasing the shares at $115, and then immediately sells those shares at the market price of $121 per share. The net gain on this transaction is $2 per share, reflecting a return of 50% over the $4 call option price. If the price of Steel Co. stock had not risen to more than $115 before the option's expiration, the investor would have let the option expire. The net loss would have been the $4 share initially paid for the option and reflects 100% loss because the entire amount of the investment is lost. The potential gains or losses from this call option are shown in the left portion of this exhibit, based on the assumptions that the call option is exercised and the shares received are immediately sold. The exhibit shows that the maximum loss when purchasing this option is a premium of $4 per share. For stock prices between $115 and $119, the option is exercised, and the purchaser of the call option incurs a net loss of less than $4 per share. The stock price of $119 is the break-even point because the gain from exercising the option exactly offsets the premium paid for it. At stock prices greater than $119, a net gain is realized. The maximum gain from purchasing a call option is theoretically infinite because there's no limit to what price a stock can reach. The right portion of the exhibit shows the net gain or loss to a writer of the same call option, assuming that the writer obtains the stock only when the option is exercised. Under this condition, the call option writer's net gain or loss is the call option purchaser's net loss or gain. The maximum gain to the writer of a call option is the premium received. The maximum loss to the writer of the call is infinite. Several call options are available for a given stock, and the risk-return potential will vary among them. Assume that 3 types of call options were available on Steel Co. stock with a similar expiration date as shown in this exhibit. The potential gains or losses per unit for each option are also shown, assuming that the option is exercised on the expiration date. It's also assumed that if the speculators exercise the call option, they immediately sell the stock. This comparison of different options for a given stock illustrates the various risk-return trade-offs from which speculators can choose. Purchasers of call options are normally most interested in returns or profit as a percentage of the initial investment under various scenarios. For this purpose, the data used to create this exhibit can be expanded to reflect returns for each possible price per share of the underlying stock as shown in this exhibit. For example, at the stock price of $116 shown in the left column, call option 1 generates a return of 10%, or $1 per share, profit as a percentage of the $10 premium paid. Call option 2 generates a loss of about 14%, a $1 per share loss as a percentage of the $7 premium paid. And call option 3 generates a loss of 75%, a $3 loss as a percentage of the $4 premium paid. As an alternative to call options, investors can use put options to speculate based on their expectation that the price of the underlying stock will decrease. Assume that a put option on Steel Co. is available for an exercise price of $110 and a premium of $2. If the price of Steel Co. stock falls to less than $110, speculators could purchase the stock and then exercise their put options to benefit from the transaction. If the speculators exercise the option when the market price is $104, their net gain is determined to be $4 per share, or 200% return over the initial $2 premium paid for the put option. The potential gains or losses from the put option described here are shown in the left portion of this exhibit based on the assumptions that the put option is exercised on the expiration date and the shares would be purchased just before the put option is exercised. The exhibit shows that the maximum loss when purchasing this option is $2 per share. For stock prices between $108 and $110, the purchaser of a put option incurs a net loss of less than $2 per share. The stock price of $108 is the break-even point because the gain from exercising the put option would exactly offset the $2 per share premium. The maximum gain from purchasing the put option is $108 because this gain would happen when the stock price reaches zero. The right portion of the exhibit shows the net gain or loss to a writer of the same put option, assuming that the writer sells the stock received when the investor exercised the put option. Under this condition, the put option writer's net gain or loss is the put option's purchaser net loss or gain. The maximum gain to the writer of a put option is the premium received, whereas the maximum loss to the writer of a put option is $108 because this loss happens when the stock price reaches zero. As with call options, several put options are typically available for a stock and the potential gains or losses will vary among them. Speculating in options can be very risky. Financial institutions or other corporations that speculate in options typically have methods in place to closely monitor their risk and to measure their exposure to possible option market conditions. Now let's move on to hedging with stock options. Call and put options on selected stocks and stock indexes are commonly used for hedging against possible stock price movements. Call options on a stock can be used to hedge a position in that stock. Assume that Portland Pension Fund purchased Steelco stock at a market price of $112 per share. To hedge against a temporary decline in Steelco stock price, Portland sells call options on Steelco with an exercise price of $110 per share for a premium of $5 per share. This exhibit shows the net profit achieved by Portland when using a covered call strategy under several possible scenarios. For comparison purposes, the profit that Portland would earn if it did not use a covered call strategy, but instead sold the stock on the option's expiration date, is also shown for various possible scenarios with a diagonal line. The results show how covered call strategies can partially offset losses when the stock performs poorly, but can also partially offset gains when the stock performs well. This exhibit explains the profit or loss per share from a covered call strategy. At any price greater than $110 per share as of the expiration date, the call option would be exercised. So Portland would have to sell its holdings in Steelco stock at the exercise price of $110 per share to the purchaser of the call option. The net gain to Portland would be $3 per share, determined as the premium of $5 per share received when writing the option, minus the $2 per share difference between the price paid for Steelco stock and the price at which the stock is sold. Comparing the profit or loss per scenario with and without a covered call strategy, it's clear that while the covered call strategy limits the upside potential return on stocks, it also reduces the risk associated with a decline in their market values. Investors may also use put options to hedge stock positions. This strategy is equivalent to purchasing insurance in case a negative event happens. Long-term equity anticipations, or LEAPs, are options that have longer terms to expiration, usually between 2 and 3 years from the initial listing date. These options are available for some large capitalization stocks, and they may be more of an effective hedge over a longer term period than using options with shorter terms to expiration. Now let's discuss options on ETFs and stock indexes. Options are also traded on exchange-traded funds, or ETFs, and stock indexes. Financial institutions and other firms commonly take positions in options on ETFs or indexes to hedge against market or sector conditions that would adversely affect their asset portfolio or cash flows. Because stock indexes are available with various exercise prices, portfolio managers can select an exercise price that provides the degree of protection desired. Like the LEAPs on specific stocks described earlier, LEAPs on stock indexes can be used to hedge stock portfolios over longer time periods. Dynamic asset allocation involves switching between risky and low-risk investment positions over time in response to changing expectations. Some portfolio managers use stock index options as a tool for dynamic asset allocation. Just as a stock's implied volatility can be derived from information about options on that stock, the stock index's implied volatility can be derived from information about options on that stock index. The same factors that affect the option premium on a stock affect the option premium on an index. Thus, the premium on an index option is positively related to the expected volatility of the underlying stock index. The next learning objective relates to options on futures contracts. An option on a particular futures contract gives the owner the right, but not the obligation, to purchase or sell that futures contract for a specified price within a specified period of time. Speculators who anticipate a change in interest rates should also expect a change in bond prices. They could take a position in options on Treasury bond futures to capitalize on their expectations. If speculators expect either a decline or increase in interest rates, they may consider purchasing a call option or a put option on Treasury bond futures. If their expectations are correct, the market value of Treasury bonds will either rise or fall, and the price of Treasury bond futures contracts will also rise or fall. The speculators can exercise their option to purchase or sell the futures at the exercise price, which will be lower than or higher than the value of the futures contract. Options on futures contracts are also used to hedge against risk. In particular, financial institutions commonly hedge their bond or mortgage portfolios with options on interest rate futures contracts to create a gain that can offset a loss on their bond or mortgage portfolio while still allowing some upside potential. Financial institutions and other investors commonly hedge their stock portfolios with options on stock index futures contracts to create a gain that can offset a loss on their stock portfolio while still allowing some upside potential. The next concept relates to options as executive compensation. Many firms distribute stock options to executives and other managers as a reward for good performance, and acts as a mechanism to increase the executive's incentive to make decisions that increase the value of the firm's stock, since their compensation from options is tied to the stock price. However, many option compensation programs don't account for general market conditions. As a result, executives who own stock options when general stock market conditions are more favorable may earn high compensation because their firm's stock prices increase substantially during that period, even though the firms perform poorly relative to others in the same industry. Another concern with using options as compensation is that executives with substantial options may be tempted to manipulate the stock's price upward in the short term, even though doing so adversely affects the stock price in the long term. The last key concept in the chapter is the globalization of options markets. The globalization of stock markets has resulted in a corresponding need for globalized market in stock options. Options on stock indexes representing various countries are now available, and options exchanges have been established in numerous countries. Portfolio managers residing in these countries can also use this strategy to hedge their stock portfolios. A currency call option provides the right to purchase a specified currency for a specified exercise or strike price within a specified period of time. Corporations involved in international business transactions use currency call options to hedge future payables. Speculators purchase call options on currencies that they expect to strengthen against the dollar. A currency put option provides the right to sell a specified currency for a specified exercise price within a specified period of time. Corporations involved in international business transactions may purchase put options to hedge future receivables. Speculators purchase put options on currencies that they expect to weaken against the dollar.